And so everyone, Mike is thank you, Sheena. Mike's a friend of ours. He's a capital partner of ours, and so he's close to the money, just like some of us are within the NPLA as well. You guys are in NPLA, right, Mike? Oh yeah, that's right. That's how we met. So what's the feeling in at the expo?
Well, they had some panels, of course, right? And nobody really showed any panic. Okay. They was like, look, investors still need to do investing business because that's how they feed their families, right? I had this discussion with my mom who actually got me in the business. And in the 80s, she was doing loans at 21%, right? So, I think that rates are going to fluctuate, and we need to just continue to look for opportunity in the midst of what some might call chaos. But I think that there's a ton of business out there on the tables, right? I met probably 200 people yesterday looking for partners and wanted to fund fix and flip business, and some realtors off the street, some new people getting into the business. I'm always an optimist, right? I always see opportunity. I can tell you from a lender's perspective that we are adjusting rates, right? So we have to adjust rates for our weighted average coupon to be high enough to where we stay at par, at least profitable, to move through these changes. But Keith Lynn, the CEO of our company, that's very knowledgeable in this business, he's like, we have to push the pig through the python, basically, meaning that some of our competitors and some of the other people that have these massive pools of loans with a weighted average coupon at 1.5% under what market calls for right now, they're just going to have to take a hit on some of their pools, and they're going to have to just push those losses out on the balance sheet. But it's hard to say what the future is with so many unknown questions to be answered regarding inflation and the nation and administration and wars and everything else. But we meet 2-3 times a week, the vice presidents and the capital partners, about where pricing might be and pricing might be at. We went up over 1 point in our rates this week alone, right? But that's just where the market's going, guys. And we sell solutions and opportunities. I don't think anybody on this call is really selling their rates, but they're selling getting things done. They're selling customer service. They're selling your integrity, your reputation. And it just is what it is. But one thing that's good in settling for me is that it's not our company. It's the industry.
Yeah.
So if you're dealing with smart people that understand industry, you can just put your feet down solid, lean into your relationships, and know that, guys, this is what the cost of business is going to be right now. What do you got? Let's get it closed. And that's just what I'm doing. So I hope that helped in my little snippet there.
No, that's perfect. Great insight. Because off of and then maybe we'll have Alex talk about what was kind of said on our call with the NPLA, because it was a little bit of a mix. Some were kind of doom and gloom, but I think the majority were echoed exactly what you're talking about. It's something too that we should be wary about, or just keep eyes on, try to stay looking ahead. And when you guys meet to like the 2 to 3 times a week to discuss like market conditions and stuff, is 2 to 3 times a week normal, or is that because of things are very volatile and changing right now?
We have 2 manager meetings a week, period. Right. And this is just so we can look at competitors' rates. We can talk about capital markets. We can cast vision for the company in general. But lately, of course, the core conversation has been, we got to keep an eye on things. You got to be aware of what's going on in your industry. Now, is there a panic situation? No. I really honestly might think there may be some very smaller lenders that could possibly pause their business or maybe even close their doors, which is heartbreaking. I care for everybody in my industry. I love this industry. It's given me the opportunity to live a life beyond my wildest dreams. But if you are a smaller person that doesn't have a lot of liquidity, you're maxed out as a pass-through lender, it could affect your business platform. So it's something to be aware about. But again, how do you look at things? Glass full, glass half empty. Just keep an eye on things and just continue to fund loans and do business.
Yep. Gotcha. Thank you, Mike. And I think that's true, because especially if you're pursuing a strategy like flipping houses, right? I think now more than ever, since majority of us on the call are investors as well, now more than ever, the fundamentals are so important, right? So understanding market cycles, understanding what drives certain markets, understanding what market you're in, right? So the team and I have been kind of going back and going back to just the basics to remind ourselves, because if we're disciplined and savvy professional real estate investors, then certain shifts shouldn't spook you either way, because all we do, we don't change the strategy, we just change the criteria, right? So when you start to shift towards a buyer's market, when we've been in a seller's market for like over a decade now, especially in Hawaii, in markets like Hawaii, Seattle is kind of, it goes up and down a lot quicker than Hawaii. Hawaii barely ever retracts. But with that said, we have to remember that like markets do cycle, and where are we in the cycle, right? So, and everybody, that answer is kind of arbitrary because nobody really has a crystal ball to know where we are. But there's a lot of indicators right now that we're kind of shifting towards a pullback and a possible buyer's market, which changes. It should just change your criteria, your buying criteria. So instead of having to buy at like 65% of the ARV, maybe you have to buy at 60 or 55, now. And because as it shifts, right, when you start to head into a buyer's market, it's less competitive as it has been recently. Recently, we've been in a strong seller's market, so we're constantly competing for deals. So we have to compete on terms and price, closing timelines, earnest money deposits. So now as the market shifts, we should start to see the leverage kind of flow a little bit more towards buyers, right? But if you're flipping properties, you got to remember you're on both sides, right? The buy side, you're up on front. Then you still have to remember that you're going to be the seller too. And if it's a buyer's market now the buyers have the leverage. So what does that mean? How do we change our criteria? Well, we should probably have to assume that we're going to be sitting longer on market. So increasing your holding times, your estimated holding times before you go into the deal. And then also maybe lowering your ARV a percentage rate, assuming that, okay, what if we're riding the downtrend, right? It's still okay as long as your buying criteria changes to mitigate that risk, right? So when you know that the market's slowing, the buyers are getting more leverage, so that means that whatever ARV is showing now, perhaps I got to drop that by like maybe 5%, or more if you feel that's how you need to mitigate your risk, right? And then maybe we have to buy again, instead of at 65% of the ARV, maybe we're buying roughly around 60% or 55. And so we don't change the strategy, right? We just change the criteria. And then the other thing with understanding the fundamentals is, are you pursuing the right strategy in the right market, right? So Hawaii is a very strong equity and appreciation market, but a very poor cash flow market, right? It's hard to cash flow out here because we're not in a cash flow market. So if you're looking to buy cash flow properties, it's very hard to find a property that you can cash flow here unless you buy it right. So, and with the same thing goes on the other side, is if we're in a very strong cash flow market and all we're doing is focusing on equity deals or equity strategies like buy, fix, sell, fix and flip, or ground up construction, then we're going to have a hard time with that too, because that market's not really designed for equity deals because it's not an equity market, right? So touching up on the fundamentals is probably more important than ever in times of uncertainty, times like these. So, and then also I think being a part of groups, like how we're a part of the NPLA, we have our Coffee Talk family here that we can open up the room so everyone can have a voice and voice their opinion, because nobody really knows what's going to happen. So I think all of us have to look back on the fundamentals of what's driving the economy right now. And for and understanding your market. So Hawaii, like we primarily invest in Hawaii, Seattle, and Vegas. Hawaii is a very the number one economic driver is tourism, right? So that's how the state makes money. So we rely on tourism, and knowing that, okay, how is the travel industry gonna be affected, right? But the one thing about Hawaii is that we're notorious for having short supply and inventory, right? That's what carried us through the downturn in COVID, where we didn't really see too much of a pullback. And we're short supply and inventory. We're represented by every branch of the military on Oahu. So there's like 200,000 transactions happening from just the military alone, and that won't go away. But how is the majority of the housing market going to respond to this? I don't know. That's why we have these calls and these groups. So I'd like to actually open it up to people in the room to get their opinion. And because I know a lot of us are boots on the ground, we're in the trenches. So I guess any kind of group should have a pulse on what's going on in the marketplace, right? And guys in the NPLA and Michael here giving us his insight, they have the pulse on the market, what's going on in the capital markets and on the finance side and the money side, as well as the investor side, because Mike originates as well. So you got to kind of know both sides, right? That's why speaking to maybe even your loan officer, whoever is closing for you, asking them questions could be great insight, because they have the intel they're getting from the finance side and the investor side, the development side. So maybe Ashley, you got any input on what you got, what we're seeing out there? Are you seeing longer days on market? Are you seeing price reductions?
Yeah, I just did my first price drop on a condo in a couple of years. So that's a little different, right? Because it's in Waikiki and in town, and there's an influx of units available there. And that also is, I think, a geographic thing, because in certain areas you have a lot of places that were Airbnb or short-term vacation rentals. So those people are starting to flood the market as well. If you see really high maintenance fees because they waited so long, without having that short-term income. So definitely in certain areas, I'm seeing a slowdown. When it comes to the listings we just went live on, though, we still got multiple offers, still negotiated some appraisal clauses, which were surprising, even though we only had a few offers. I know when we represent on the buy side, we're able to, not give up our unborn children to get an offer accepted, which is good. But we still are depending if it hits everyone's check boxes, right? So if it's a house that has covered parking and it has, a view and it's got a big yard, you're still going to see those go competitively. But if it's a basic style house, nothing too wow about it, entry level, definitely going to have some probably, normal market offers. I don't think that we're going to see a crash per se, but we have a situation right now where in Makakilo, we're under contract for 2.1 on a property, one of the agents on the team, and there was a sale that just closed for 2.1 in a gated community. And before, appraisers would use that and they would do anything they could to get to that justification, and buyers would be willing to pay that difference. The appraisal came in at 1.8, and it was a big gap. And essentially, the sellers really had to come down on price quite a bit, when before the buyer would just be coming in with the whole 300,000 out of pocket.
Right.
So, and that house checked a lot of boxes. So that's, but we still are, buyers still coming in with money, but not all of it. Sellers reducing quite a bit as well. So definitely a shift.
Yeah.
Some more inventory in certain areas too, which I think is going to come here. Right now we have military relocation on the island, so we are going to see things still moving a little bit faster, but as soon as the relocation stops, I think we're going to start to see a larger impact over the next month.
Got it. Yeah, that's great insight. And it's interesting to see because now when we're drafting offers, right, like we have to think about that longer holding times, right? And uh perhaps if appraisals come in undervalue, whereas like Ashley said, whereas before perhaps the buyer would have to come to the table now, or sorry, yeah, the buyer would have to come to the table to make up the difference. But now it's shifting where perhaps they have the leverage. Now the sellers may have to drop the price, so
Well, and when we're going over deals, like we just went to a project with Roderick, found on off-market property, and we went to this property with Keone, and we're looking at ARVs. And even though the house right behind appraised at 800,000 and it's an inferior product, we're still running our numbers more conservatively at 800,000 or below, just to help. So say what we would have said last year and been like, we still see the market going up. We're going to put an estimated ARV at 830,000. Now we're saying, okay, well, let's run our ARVs at 780 to 800,000. And then we'll work off of our worst and best case scenarios. And that's something that just happened in the last couple of weeks. And, we have clients right now too, if you have any projects going on market, buyers are locked in at certain rates at 5%. And like that one for, 2 million, the buyer's locked in at 5% at $2 million loan or even $1 million loan. If they had to extend or they couldn't negotiate or file out a contract, it's now just in these 3 weeks at to 5.75%. The monthly payment on that mortgage for that borrower, just the interest rate difference would have been about $800 per month. And that's a big impact for the seller. So that's actually how the seller said, no, we're not going under, 2 million. They'll only knock it down 100,000. We have a $300,000 gap. They didn't want to wait for us to dispute the appraisal because we felt like we could have bridged it a little bit more, maybe 50,000 to 100,000. And they didn't want to wait the 1 to 2 weeks that takes. And the lender called, we called, and we're just saying, hey, if you come back off market or come back on market, the buyers now are going to be paying near almost 6% and a jumbo loan. That monthly payment is going to be, like I said, almost $800. You're not going to get the same price. You're going to end up landing at the same number anyways. And they came back this morning and agreed. So using that as negotiation as well for you guys when you're finding deals and you're trying to lock in deals and you're coming in with your negotiations with the client on the other side, just saying the market's shifting. We got to make sure we prepare for depreciation, 3 to 5%. And also, we don't have the same leverage that we used to. So putting in some extra room, some extra wiggle room for negotiations on the back end.
Got it. Love it. Perfect. Yeah. And I guess Ben, what are you seeing in Washington?
Yeah, we're definitely seeing things slowing down. We had, we just had crazy appreciation.
Mhm.
And we're seeing things sitting longer. We're seeing price reductions. I'm seeing people pulling things from the market, probably because their agent is telling them, hey, we need to be at this price. And the seller is saying, well, but 3 weeks ago, everybody was getting $400,000 more.
Yeah.
And, they can't bridge that gap. So,
Sticker shock a little.
things coming off the market for those sellers that can't quite get with the picture. I'm sure we'll see them come back on at the lower prices. And, we're still seeing multiple offers and stuff, but it's significantly reduced. And, buyers just, they can't pay these higher interest rates at the, kind of the prices that we were at. And appraisals are coming in low. And so things are starting to adjust for sure.
Yeah. Okay. Yeah. Thanks for that. Cause Washington's a tricky one for me. It's I think I mentioned last time on the call, we had a couple projects out on Mercer Island and they went long and like over a year. And through the course of the year, we went through like 2 cycles in that market. It's such a roller coaster. At first, it was like, oh wow, this is great. Like, the market's going up. Like that house sold for like 200 higher than we expected. And then like maybe a month or 2 later, it's like, oh no, like what's going on?
Our market swings wildly and quickly. So
it
it is quite a bit of a roller coaster around here. definitely
That's what I
being a
noticed.
lot more
Yeah.
conservative on running numbers and
Mhm.
for the agent side of the business, what I'm telling my clients what to expect out of price.
Yep. Yeah. In Seattle area, we noticed like Keiko and I looked at that market for like a year before we actually put a dollar out there. And just watching that year, when we first looked at it, it was just a frenzy, man. You couldn't buy a property unless you're gonna buy cash and close in 2 weeks with no
Yep.
due diligence, no contingencies. Like we're like, maybe we can't invest in this market, but we waited it out and it came back around. And since then, like almost like twice a year that like in some of those markets just go up and down. I couldn't stand it. I was like, oh man, okay, you handle this, Kiko. I'm gonna go back to Hawaii where it's
Yeah.
always up and to the right,
Yeah, like historically, it's been super seasonal here, like most of the country. But the last, I don't know, 18, 24 months has just been kind of up and to the right constantly. And so everybody got used to that. And now they're like, oh, it's not like that all the time. It's like, yeah, no, we're going back to normal market fluctuations here.
Yeah.
Things have to go up and down.
Yeah. And that's why like they say in times of hardship or when there's a pullback or the housing market's going through a recession, it's like the guys who understand the fundamentals are gonna still be around, so, and that's understanding where you are in the market cycle, not just nationwide, but also like in your specific market. Because even in the last Great Recession, it was a lot to do with the housing market. It started with the housing market. And even there was pockets of markets across the nation that were not in a recession. So we just have to understand that not only are markets cyclical, but they're also specific to certain areas, right? So even from the different islands across the state of Hawaii, they're drastically different. So I think understanding where we are can help you not overreact as well, right? We want to be proactive rather than reactive for sure in these times, but we also don't want to overreact and overcorrect, right?
Hey,
So-
Corey, can I add something real quick?
Absolutely.
As a street originator, when you're out there hustling deals, I would probably consider selling a little bit of a less of an LTV to be proactive. Because what's going to happen, and if the market values slightly get reduced, anything that a lender funds at 65 to 70 would end up being maybe 75 to 80, depending on where the market fluctuates. So I can tell you across the nation, you're going to see some lenders restricting a little bit of LTVs, maybe shifting their guidelines around to manage any property value reductions. So if you've got a customer and you look up front, you're vetting your deals and you know they have some extra assets, have a real transparent conversation with them about the market. They'll appreciate it so much and say, hey, look, lenders are tightening up a little bit on LTVs. Be prepared to invest a little bit more cash flow into the deal. It's just where it is on the market. I'll continue to keep you updated as I'm updated for my investors. Be transparent and open with these folks. They'll really appreciate it. But consider, maybe a little bit less of an LTV. It's going to just save some issues in the long run for you. Just a suggestion.
Yeah. And are you saying this too, Mike, because things are changing so quickly that by the time you get like your first term sheet out, right, at let's say 65 or 70, and then by the time you head to close, maybe things have shifted and the leverage has to go down, or the value's gone down, so the leverage, that means that you're providing has gone up past your guidelines, right? So then now that loan is no longer a feasible loan. Is that what you're saying?
That is correct. And investors that are buying these massive pools of loans are nervous about that, right? So, they may offer a little bit less for higher LTV thresholds. So I'm just telling you that this is what we're kind of predicting in the market, that you may see a little bit more required, less of an LTV than you may have been used to over the last few years. I see that coming, just to make sure that, people don't get hurt or burnt. Because ultimately what ACRA wants to do is to partner with people all over the nation to make sure that our industry, for all of us, stays balanced and doesn't get out of whack. So anyway, I just thought I'd throw that out there because that's something that may change LTVs in the future.
Yeah, I think that's a great point because leverage is gonna. I think it is gonna change the. And just to point out to everybody, like the call, the feeling on the NPLA call, there was an actual discussion about how, perhaps like we or the lenders have been too aggressive with the leverages and the rates that now they have to change course to help mitigate their risk. And they have to drop the leverages and increase the rates, especially since, the cost of capital has been going up, 75 bips since a couple of days ago, right? Or yesterday. I think it was yesterday. So it does take a little longer for the bridge loans I've found to have a price change. But we just got one, another 50 basis points. That's half a point up. And the DSCR loans, the 30 years, are just getting creamed. It looks like I think half of the market has dried up. So the DSCR loans are hard. It's kind of like a vicious cycle because once the rates go up, it makes it harder to cash flow, which makes the DSCR go down. And in order to correct that, you have to raise rents. And you can only raise rents so much before it's just not feasible anymore for the market that you're playing in, right? So there could be the DSCR loan products and the people who are going into the 30 years, they're getting kind of squeezed a little because their cash flow is getting smaller because the interest rates are going up. That's what I've found. So the DSCR more than any product has gone up tremendously. Like we were starting at 3.25% at I think the beginning of the year, and then by now like guys are starting in the 7s, the 8s, and this is for a 30-year amortized loan, But we also have to remember too is like if we're doing our job and we're getting deals at the right price, factoring in the market environment that we're in, right? So you're buying even at a deeper discount with maybe more value add, right? Then you should still be okay. And closing the loan is fine. Maybe your cash flow is gonna be substantially smaller than it should have been. But think about like, you're not gonna have that loan for 30 years, interest rates will correct at some point. So maybe it is time to look at what is the interest, the 5-year interest only options look like, or the ARM products, see what that looks like. Because if it works out, then perhaps we go, you go into that and then you get taken out when things settle down with a refi later. But every deal is different. But I think now's the time more than ever to start thinking that way and looking at more of the fundamentals before we go into any especially any big project. Now I guess maybe who would have a good pulse on the materials? Keone, maybe you. Do you know how does the materials looking now? Is the price gone? It's gone up, but
I mean, it's gone up, but not like, to me, it's kind of fluctuating, just like the market. It's like it all depends on who you're grabbing your materials from. I would like to say a couple of things. I mean, I didn't jump on at the very beginning, but right when I jumped on, I mean, this is a good one. What is the date today? The 17th. You unpacked some amazing nuggets, man. So like, this is definitely a rewatch. Like there's a lot of key indicators, phrases, words that you use that if you watch it over, it will make sense. But the reason why I'm saying that is because, yeah, everything you said, because I am from a boots on the ground standpoint and I'm a fix and flipper local here. And everything that you talked about, going back to your fundamentals, buying it right, like all of these things, like regardless of what the market is doing, stick to your disciplines. These are all the factors. And I think because we come from the same school, and we've seen cycles, and we are shifting. I think the concern is for the newbies that are coming in. They've been actually on this rush you know, like the seller's market where like it was okay to speculate, right? Like, nah, I'm gonna just rush because look at how it's just a seller's market. But now we're seeing a shift. This is when the disciplines, and I think no matter when it shifts, I think my mindset has always been, and this is just the way I've always looked at it, is that the phrase is we make our money when we buy it, right? So as long as you buy it right, you know what I mean? I think you just said it right before you called on me. It's like, we'll be okay. You know what I'm saying? So I think if you can stick to those fundamentals, and I'll give you a boots on the ground, literally like a real live deal right now, just to put numbers to it. I have a deal right now that I'm about to close next week with Keiko Capital. Thank you guys. So this is on the west side, another one on the west side of Oahu, right? So I bought a bunch, and that's my market. Like you said, learn your market, your specific market, and just have a pulse on it. So I know if I can buy houses in that area, single family homes, for anywhere in the $400,000 range, the houses over there, because it's just a boom. There's so many houses, brand new ground ups, whatever, residential redevelopments going on, that is comping out at 800,000. So this is a real life scenario where I'm buying it 400,000, range. And I just got the ARV back where the appraisal got done. It's 800,000. So it's a 4-bedroom, 2-bath, whatever the case. There's value add scenarios where I could do to it. My renovation for that is about 100,000. Now you talked about being conservative. It's 800,000, but I'm going at 750 because it's going to take me 6 months, but it might take me 8 months. So all of these numbers I'm padding. You know what I'm saying? So like everything that I'm talking about is like you just said it, but this is a real life case scenario. That I'm saying 400,000, even though it's going to cost me because I know my crew, it's going to be 100,000. I padded it up 120, 130,000 for you just said materials. I don't know where it's going to be, but that's my numbers. ARV 800,000. I brought it down 750. I feel that I can get it out 6 months. I'm padding it 8 months, and the numbers is lower. My net profit right now, conservatively, is actually on the low end, but I know that because of my disciplines, I feel that I'm going to come out on top. It still be a profitable deal, but I can withstand anything that's going on within the market, any shift, any interest rate, and I'll continue to keep my buyer pool open because within the next 6 months, we don't know. You said it as well. We can't predict it, but I want to prepare for myself. So that's why I pad, be conservative, all these numbers. And in the event that 800 is no longer there, well, I'm okay because I already brought my number like 50,000 plus down below and I'm still profiting it. So that's a real life scenario. And that's the way I'm looking at all my deals.
I love it. And I think that's a huge and important lesson because first we have to understand that the fundamentals are actually important for you to even think about, okay, things are kind of shaky. The indicators as well, right? So days on market goes up, right? Price reductions are going up as well, but the prices are going down. So those are indicators saying, okay, the market's cooling off. We kind of were on a huge huge bull run here. So we need to factor in a correction, right, of some sort, and maybe not a recession or like something to push us in where we're on a downtrend, but at least a correction, because there was a lot of money out there, and obviously inflation is no longer just something that's going to pass through. It seems it's here to stay, and it's a real problem that we're dealing with now. So, but with all that inflation, especially in the housing market, it's got to correct at some point, so we have to look at those indicators and take those into account. And what I liked too is that not only did you take off 5%, because maybe you're thinking, okay, maybe the market might pull back like 5% by the time I'm hitting market, but there's a little bit more onto that. And I think that's important too, to know, because if we're seeing, the market go down roughly about 5%, we have to remember that we might also sit for a little longer, so for guys like us who are taking in high interest loans, we're paying thousands of dollars every month in interest, right? So maybe it's 5,000 a month, and maybe you added 2 more months to your holding time, right? Which is smart. And that's an extra 10 grand. So that's how you get your 50 right there. So you factor that in. You know, most people might think, okay, I think there might be a 5% correction. So I want to make sure that whatever my ARV is showing now, I'm going to deduct it by 5%. And then that's it. But if you understand the fundamentals, you understand that it's not just the price reduction in the ARV, it's also your extra holding times. So that's an extra 2 months worth of high interest, maybe at $5,000 a month, you know, so that's an extra 10 grand that you put in. So instead of selling at 800, which 5% reduction is 40,000, you went to 750, which would factor in any extra holding costs. So like that little, it seems like little adjustments, but it's not. Those are big moves that we have to start thinking about. Now, if Keone, in the worst case scenario, if Keone overcorrected himself, right, and perhaps reacted a little bit more conservatively, like too conservative, I'd rather be conservative through times like these than be, you know, optimistic and wrong, and you know, and then you lose 50 grand instead of, you know, save 50 grand.
Yeah.
So that's
when we underwrite these deals, right? When we running deals, we have a tendency, even especially when you're starting out, that you want to make the numbers work, right? You're trying to like fudge these numbers, like, oh yeah, if I move my ARV up. But I just showed you that I literally got an appraisal for 800,000. Great, awesome. I don't care about that because I don't know what's going to happen in 6 to 8 months. Let me just bring that down because that number is based upon the now. It's going to take me at least 3 months. So I can't control the market, but what I can control is my guys. So what I do is I push my crew. Like I feel that we can get the job done in this amount of time because we need its speed, right? We got to get it back on market. So that's what I can control. So that way I push. So if this job it's going to take 60 days, I want to bring it down less than that. So that's who I can push my guys and incentivize them. We got to get this done. We got to get this done. What do you need? So like all of the materials, whatever we need to speed to get it back to market, that's what I can control, right? We talk about all the appreciations. I'm buying it, right? We instant appreciation, creating it already. Now I'm going to force it with my guys. We're not going to control the market, but if I can get it to it now, it's still in that factor where like it's still technically seller buyer, but now I'm okay because I brought it to market faster than anticipated. That's what I can control. And this is not something new. This is like of our school, right? I've always been conservative and consistent. It's just now more of the disciplines is a big deal that I think you just talked about. We got to really stick to fundamentals.
Yeah. And it's okay to lose bids. You know, it's okay to lose out on deals. It's okay to not be the highest bidder and move on, you know? So yeah, we don't gotta take down every single deal out there, you know, even though that's ideal. Like you gotta take care of home base first, you know, because if something goes wrong with one project, then you know, and then that affects your buying power and your ability to execute. Then like if the captain of the ship goes down, the whole ship's going down. Most likely, you know, so gotta take care of home base first, make sure we're buying right. We're putting our lenders in you know, who are backing us behind good, solid, conservative, you know, and those are the guys that will stick around. You know, they don't get caught up in the frenzy and stuff, and they understand the environment that we're in. So thanks for the insight, Keone. It's always great to hear from you on that one. Does anybody have, or is anybody in the middle of like a cash out refi or going into a long-term 30-year, just a long-term rental loan, and has seen changes? Because that space has actually seen the biggest spikes right now that I've seen in rates and potentially leverage soon. So
Yeah, I just finished one up.
oh, hey Ben. Oh really? It's okay.
Yeah.
Anything to
So when we originally took it down in November, rates were around 3.5, maybe 4, and we baked in like 4.5, but we still had a ton of equity. So we just closed out a 30-year DSCR at 6.5, and I mean it's still cash flowing a little, but we had to leave more money in the deal. You know, originally we thought we'd get basically all of it out. I mean, price
so you were
really
able to get all of it out?
No, that's what we were shooting for.
Right.
But with the rates higher, in order to keep the cash flow, because we're basically maxed out on rent, which is still pretty good in our area.
Mhm.
We got a little bit of cash flow, and then we had to leave about 70 grand in the deal, which is fine. We've still got a ton of equity. So like we were super conservative from the beginning, and the appraisal came back way higher than our original numbers. So we've got a whole bunch of equity. It's just we've got a little bit less money out of it to play with.
Yeah.
And we just wrote all that stuff in there. Even though we were conservative, the numbers went even beyond that, but still, because we set it up that way from the beginning, it's like it's not a big deal. We took what we could and we move on to the next one, and we've got a great property that's cash flowing and appreciating, and it's just got a little bit more of our money in it than we were hoping, but it's not that big a deal because we were conservative from the beginning.
Yeah. Because you're conservative from the beginning, right? Yeah.
Yep.
And even that, in that scenario, if it was back in November, nobody knew that within 6 months, like
that was the buy everything no matter what the price time was. That was, everybody was in a frenzy trying to get everything, like nobody was foreseeing. So that's why we were like, well, let's add a point to be conservative. At that time, who could imagine an entire point,
Yeah.
And of course, then it went up 3 from where it was when we bought it. So,
Oh man. So you were at
nobody
3.5.
Yeah, it was at 3.5. Mm-hmm.
And you closed at 6.5 or 6.5.
6.5. Yeah. Yeah.
Wow.
Like market rate was about 3.5 when we took it down.
Yeah.
And we said, well, let's bake in 4.5. We'll still get all our money out. It'll be great. And then it ended up being 6.5. We had to leave a little money in the deal. It's not the end of the world. You just got to make sure, like Yoni was saying, just be conservative on every single measure from the beginning. And then even if things change, even drastically, you're going to come out all right and you can move on to the next one.
Yep. Yep. Well, and that's just you talking about it too, because most people, especially in these times where everyone's winning, it's hard to lose in a market that we were in, but Ben's here where he started his deal out with, there was no indicators at that time, so it's business as usual, like let's buy everything we can, and like we're riding this through. Then it comes time to exit with a refi, and things have changed, not just even slightly. I mean, that's dramatically. It's almost double.
Yeah, pretty much.
That you got. So that's like double the cost every month, right? Like, so, but like Ben's reaction is like, yeah, wanted to take out 70 from the deal. Like we have to leave 70 in there, but it's all right, because he knows that it's part of the game, right? Like if there is a loss in there where it's going to be a loss and you're selling the thing and for less than what you put in, and now you're upside down on the deal. Yeah, that one stings a little, but look, I always say, like, if an investor is telling you that they've never lost money in the deal, then they either haven't been doing it long enough or they're just lying. Like you play this game long enough, you're going to take hits, right? So you just want to make sure that the first few deals are like home runs or at least doubles or triples. You don't want the checkmate on the first deal. But once you get that momentum and if you do it long enough, you're gonna take some hits on some deals. It's just the way the game is, So, but when you're most vulnerable, at the beginning, if it's your first deal, I think it's now more than ever very important to maybe partner up with someone who's been there, done that already, just to look over your shoulder. I would give away equity in a deal, no problem, just to have someone to have my back, because it's that important when it's your first few deals to be successful. Because if you take a big hit, we've lost big money on some deals before, but we lost, our investors never lost, our lenders never lost, because you got to take care of those guys. That's the lifeline of our business, right? So if you don't take care of those guys, it's checkmate, right? So whenever there is a loss, like, yeah, it's good to, learn from it, let it sting. If it doesn't sting you, then that's a problem too, right? Like we need to bask in our failures sometimes so that we never do that again, right? So I think making sure that we learn from our mistakes if you lost money in a deal, but also knowing that, look, if it didn't bring you down, it's only going to make you stronger, because now you've learned and now you will never do that again. Right. So, but still, if it's the first deal, I think it's best to hedge your bets and like have someone bring somebody on as a partner, give them equity, have them vested in your success long term. If you're looking at this venture long term with sustainability, that's what you need to do. If it's your first few deals, have someone come on with you just to look over the shoulder, give away half if you have to. It's worth it. It's like, think of it as the price of admission, right? People go into student loan debt up to like 100 grand or more sometimes to get a degree that they may not ever use. So why are we so scared to give away half of our profits to somebody who can just be there to look over our shoulders and make sure we don't do anything stupid and blow this whole thing up? Like, it's a no-brainer to me, but somehow we feel like giving away profits to somebody is we're losing out. We're not losing money, in my opinion. It's like, it's worth it. So, and I've learned a lot doing that. I know Keone's learned a lot partnering up with other investors. So wow, we are almost at the 11 o'clock mark, but does anybody else have anything to add with what they're seeing? Oh, hey Greg, maybe out in Maui. How's Maui looking?
Hey, Corey, good to see you. Man, I haven't been on the call in so long. It's one of those things where,
good to have you back, man.
like 1 week it was just like had stuff going on, right? And then I don't know, it snowballed. So I was like, no, that's it today. Like, doesn't matter. I'm gonna be driving. I gotta go find an oven for this rental, but I'm just calling in, right? So no, I appreciate the call today. I mean, I don't think I'm like not somebody, I wouldn't call myself qualified to really like weigh in on this. But it's on everybody's minds. On that, while you were talking about that last topic, I was just thinking about this one deal that we just had kind of got locked up. And I had a friend of mine, I went to Florida for a month to spend time with family. And I had a buddy of mine make some calls, like, do some follow-up calls on some of my leads while I was gone. And we didn't even talk about, structure or anything. I was just like, here's all my leads, see if you can convert something and we'll figure it out if you can. And then, and he got one. And it was like pretty good one, like really good one. And he really wanted to do like a 1031 into this property, which ends up being like it's a really good CPR property, really easy, kind of quick turn and burn. And it could be a flip too. And because he wanted to do it 1031, and I'm super cash poor right now, I was like, okay, well, let's work something out. And I kind of chose to go with, I mean, there's a lot of factors, like I just explained, being cash poor, he needed to do, a replacement property. But I don't know, just because I don't know what's going to happen. I kind of have a feeling I'm going to see him selling these 2 units for like quadruple what the purchase price was. And it's going to be a really, really, really good deal. But I still I don't know. To me, it was like, I would rather take the cash today and kick myself later, which is what has been the story for the last, since I started, but like the last 2 years, year and a half, particularly, every single deal we've said, oh, it's close, but we're not compromising our criteria. And then we end up seeing them going and listing, turns out we could have just listed it as is with no rehab and made like 300%.
Right.
Yeah, no, I don't know. I mean, I'm just listening to you guys because I'm kind of taking it easy right now. I just closed on 3 rentals. I got my hands full with that stuff. So I'm not really looking at flips right now. I'm just kind of waiting to see what happens and see what you guys tell me to do.
No, I think that I agree with that move. Like like now more than ever, like, yeah, maybe we should start holding on to some cash, right? Because over the last decade, real estate investors, they're notorious for being cash poor and equity rich, like all their wealth is in equity, right? So, hey, thanks, Mike. Thank you, brother. We'll call you soon. So like now more than ever, I think it's time to be cash rich and a little bit equity poor if that's the case, you know. So sometimes that means passing up on deals that look like home runs. It's okay, you know, like it's fine. Deals will always be there. You know, there will always be more deals. But if you get into a problem with a deal and you can't get out, because sometimes that happens, that's when it becomes catastrophic. You know, like you rather pass on a deal and live to fight another day, because there will always be deals, you know. And this is my 11th year in, and I still feel that I'm still a baby in this industry, you know. Like Alex just helped secure us another mentorship with our last guy, and part of the reason why we're doing this, like, is because we need to hedge our risk, you know. Like there's too much at stake for us, you know. Like we're not just flipping houses by ourselves. Like we have teams, we have service providers that rely on us, we have investors, we have capital partners that rely on us. So there's a lot of responsibility, and I think we can't let our decisions and analyzing and contemplating, we can't let that stifle us, you know, and like paralyze us. But at the same time, I think it is healthy to stop, take a breath, tap a shoulder, you know, maybe tap a shoulder a friend of yours who has fresh eyes, and be like, Keone, what do you think about this, man? Is this a stupid buy? Would you do this? You know, and then if he says, oh, hell no, man, like, you know, I'm seeing price reductions here or there, you might want to drop that 5%, or, you know, then let's drop it 5%, you know, like, because that is what we need. We need a sounding board, and everything, you know, the opportunity is not going to disappear, right? It's just going to shift. And when Greg's thinking that, oh, you know, I'm a little cash poor right now, like maybe now it's time to sacrifice a little bit to get some cash back. I think that's a good move. You know, I think that right now, you know, like until we see what's going to happen from our mentorship call, it's like, yeah, where is the opportunity? Well, it's going to be in NPLs, they call it, right? So non-performing loans. There's going to be a lot of investors or companies that have NPLs. And like for Alex and I, you know, when we're hearing this, it's like any NPL in the state of Hawaii, like we want to buy them. We want to have the abilities to buy them, you know, and take over and execute on the deal. That's how guys have become, you know, rich through down markets, is because they were prepared for it, you know. And those guys see it real early, and so they make their moves, so they have the resources for times when we start to hit the bottom and we're going to bounce back up. You know, those are the guys that they're ready, and we want to be ready too, whichever way it goes. Maybe it doesn't pull back, you know, because there are signs that we may not have a recession in the housing market, and if we do, it's just temporary. It's short. You know, there's people out there who are you know, saying that. And if you look at the fundamentals of supply and demand, then I can see why, you know, a lot of what they say makes sense. Like, yeah, we may not see
Corey, a recession in the housing market. I mean, I don't know, maybe I'm wrong, but I know a recession generally, like, you know, big picture, is defined as 2 consecutive quarters of negative GDP.
Yeah.
So that makes me think then a recession in the housing market would be defined as 2 consecutive quarters as negative appreciation, right? So like we could just have housing, you know, kind of settle and be plateaued, and like that could theoretically be considered a recession. So I think like, I think a lot of us, I don't know, myself at least, being, you know, growing up in the 2000s, I came out of high school in 2002, so went straight into appraisal, and it was like freaking madhouse, crazy free for all stuff, right? And we all think of the recession as, you know, recession or, you know, pullback and everything. We think of like, okay, 50% off.
right. Yeah.
But I don't know. For me personally, I'm just always reminding myself, like, okay, even if we do go into, you know, if the housing market corrects, it's not always like 2008 kind of status. Like it might just be like a 5%, you know, or it might be at 2 to 3%. I don't know. What are your thoughts on that?
I think that's a great point because a recession is 2 consecutive quarters, right? So half a year basically of negative growth. And when we've seen like an explosion of growth in the housing market, having maybe what Greg, I think you're alluding to is that even if the housing market is in a recession, if it's a slow burn and it's a slow turn, then it actually, you might actually just be in a correction, you know, because maybe those 2 quarters of negative growth in the housing market, maybe that's just to bring us back down to where we were, where true values lie, right? And not with the overinflation of the fiat money that was spread amongst the economy over the last 2 years. So I think that's a good point where maybe we expanded 30% or so over the last 2 years or more, maybe it's probably more. But, you know, maybe we do go into a recession, but the recession has a pullback of 5 to 10%, you know, like, is it really that bad? You know, and I'll tell you who it's going to be bad for. It's going to be bad for the people who don't understand the fundamentals and they were buying on tight margins, getting caught up in the buying frenzies and the bids. They just want to win the bid, right? But are we here to win bids or are we here to make money and make a difference? You know, like we're not here to just win bids. Like nobody cares about that, right? So I think it's, if you look at it the way Greg's looking at it, right? Even if there is a recession in the housing industry and there's a 5% pullback, we just expanded probably like 30 to 50% over the last 2 years, you know? So, so my point is like, either way, we shouldn't be on the sidelines. You know, we still do what we do and we don't change the strategy. We change the criteria and we take the time to understand fundamentals. And we take the time to bring people around us to look over our shoulder if you have a feeling that, you know, you don't know what you're going to be getting yourself into, right? So we're doing that, right? We have 4 mentors now secured to watch our backs. And you know what's cool is we get to kind of like, what is it called? With the FBI, when they separate the witnesses and they ask one witness, they talk to the other witness and the suspect, and they triangulate or something, right? Because then you can get answers from key players from you know, different perspectives, right? And then you can formulate your own opinion off of that. So that's what we're doing. I suggest everybody start thinking the way Ben is, you know, thinking and especially after, you know, he saw it firsthand, you know, like his rates doubled almost by the time he had to close. So, you know, and Greg and Keone, we got to start thinking about everything, not just, okay, what am I going to buy it at? What am I going to renovate it for? And then also what are the comps showing today that I can sell it for? I think now's the time we have to think even deeper than that, right? So thank you guys for jumping on the call. And I think it was great information shared. And thank you, Ben, Greg, everyone that kind of gave some input. And I hope everybody has a great Father's Day. Have a great Father's Day weekend. And we'll see you guys next week. Aloha, everybody.